In the darker corners of the internet, there is a large stock market cult that has been spreading. This strange community has created a series of delusional and schizophrenic-sounding theories about organized market corruption, rampant hedge fund short attacks, and belief in a coming short squeeze that they believe will turn them all into overnight millionaires and break the global financial system. These cult theories all surround just one single stock, GameStop. But the crazy part is that the GameStop short squeeze that this community is waiting for already happened years ago. GameStop already had a social media fueled short squeeze that created over 1,500% gains in the stock in just a month, and led to the birth of this cult in the first place. The stock price has declined significantly since then, and Wall Street stopped caring years ago. The stock is unlikely to ever see the same speculative highs that it did during the short squeeze. Most people would have sold, moved on, forgotten. But not this group. They don't care that most people believe GameStop to be dead money, a failing business, and a bad investment. They have their own lingo and their own cult-like theories. And years after the rest of the world moved on, they're still here, still holding, still theorizing and waiting for something they call the mother of all short squeezes. Welcome to the strangest stock market cult you'll find, the cult of GameStop. But if you want to understand how the stock market cult got started, we need to first rewind and learn the history behind the GameStop short squeeze.
GameStop's wild ride on Wall Street took a few more sharp turns.
Has been surging more than 600%.
GameStop, right? A struggling brick-and-mortar video game retailer.
This is a stock that is moving detached to fundamentals right now.
Well, this army of small traders who are using a Reddit message board called WallStreetBets, and they're putting pressure on the short sellers of GameStop.
The record move driven by a retail rebellion.
The power of the individual to almost take down a huge hedge fund.
We like the stock. We like the stock.
The GameStop short squeeze was an event that rocked the world of finance and made headlines around the globe. In January of 2021, the struggling retailer GameStop saw its stock rise over 2,000% as an epic short squeeze caused the stock to explode upwards and create nearly $20 billion in losses for Wall Street hedge funds. As if that wasn't crazy enough to begin with, the reason the short squeeze happened in the first place was due to massive interest from retail investors on Reddit, as regular people began to flock from social media platforms to the stock market in droves to buy GameStop stock in a David versus Goliath story between Wall Street and Main Street. GameStop would become so popular on social media during this time that the term meme stock was invented to describe the phenomenon. And this event was unlike any other in stock market history. For years, hedge funds on Wall Street had been shorting GameStop, a company that was seen as a dying brick-and-mortar chain that would eventually fail due to the rise of digital games and e-commerce. But as people began to notice the high short interest in GameStop stock, there was a surge of interest in GameStop from retail investors on Reddit's WallStreetBets and other social media platforms that helped create a short squeeze so big that it quite literally almost broke the stock market. This is the story of the GameStop short squeeze and how stocks became memes. The GameStop story first starts back in 2019 with Michael Burry, a famous investor who is best known for shorting the housing bubble during the 2008 Great Financial Crisis, and being the subject of the movie The Big Short. Michael Burry noticed around this time that GameStop stock had an extremely low valuation, and after doing his research, he came to the conclusion that GameStop stock was undervalued. So he began to buy millions of dollars of the company's stock, which began to raise quite a few eyebrows as other people took notice. You see, GameStop was a bottom-of-the-barrel stock at this time and had been declining for years, with most investors viewing it as a failing company that would eventually go bankrupt. So Michael Burry contradicting the narrative and buying the stock took a lot of people by surprise. Not only was Michael Burry buying millions of dollars worth of GameStop shares, but he was also vocal about his positive opinion of the stock as well. He spoke to Barron's in an interview and said that the company's balance sheet was actually in very good shape. and that he believed that they would have enough cash flow to justify a much higher share price. Not only was he making these comments publicly, but he also wrote several letters to GameStop's management and urged the company to increase their share buybacks, arguing that the company had an unprecedented opportunity to pull off perhaps the most consequential and shareholder-friendly buyback in stock market history. But the biggest contribution Michael Burry had in creating interest in GameStop stock was that he was a sophisticated investor who had a contrarian opinion compared to the dominant narrative that was surrounding GameStop at the time and being promoted by the hedge funds that were short-selling GameStop stock. For those that don't know, the basic concept behind short selling is that when you short a stock, you're betting that the stock will go down in price. The way that short selling works is that a trader borrows shares of a stock from someone who owns the shares. Then they sell those borrowed shares at the current stock price. Their goal is to then buy those shares back later on at a lower stock price, so that they can return the borrowed shares and pocket the difference in price as profit. And many hedge funds had been successfully short selling GameStop stock for years as the company floundered. The dominant narrative at the time was that the company would eventually go bankrupt, as GameStop continued to lose market share to online video game retailers and consoles selling digital games directly to consumers. One hedge fund in particular, known as Melvin Capital, was extremely short GameStop and had been shorting the stock since 2014. Melvin Capital was founded by the up-and-coming hedge fund manager Gabe Plotkin, and the fund was gaining notoriety and influence on Wall Street as it averaged 30% returns from 2014 to 2020. But Michael Burry took a contrarian approach to the hedge funds like Melvin Capital, as he noticed that the company's balance sheet was strong and not at any near-term bankruptcy risk like the common narrative. He also believed that the company had likely become undervalued despite the struggles the business was facing. Michael Burry's initial vote of confidence in the stock in 2019 made other people look more seriously at GameStop and would be planting the first seeds for the short squeeze that would happen later. Now let's fast forward a little to the year 2020. In order to fully understand the GameStop short squeeze, you have to know a little bit about what was going on in the economy and stock market at the time. When the GameStop short squeeze first began, the stock market was flying high and speculative and unprofitable companies were benefiting possibly the most. For context, in under a year, the NASDAQ 100 stock market index had nearly doubled from its March lows during the 2020 stock market crash, when the COVID-19 pandemic first began to disrupt the economy. In fact, the stock market had been in a non-stop uptrend since those March lows, and all of the main indices were even higher than they were when the pandemic first started. You would think that the stock market would have been doing terribly during this lockdown period, but several factors combined to create an incredibly strong stock market. One of the major elements at play was that fiscal and monetary policy during this time was incredibly loose, which helped to create a massive boom in stock prices. When the pandemic first began, world governments began to worry about the potential for business failures and economic pain as lockdowns started. To combat this, governments began to give lots of stimulus money to consumers and businesses. In addition, the Federal Reserve and other central banks took interest rates to near 0%, which made it incredibly easy for people to borrow money at virtually no cost. All of these measures put lots of money into the pockets of consumers, and a lot of this money eventually found its way into the stock market. This is because lots of people began to enter the stock market during this time. With many people being stuck at home during lockdowns and looking for a way to make some money, the idea of day trading in the stock market was enticing to many people. And with the rise of commission-free trading platforms like Robinhood that could easily be installed on a phone, it was easier than ever for people to join the stock market in just minutes. And the government stimulus checks had just provided these people with plenty of new money that they could use to trade in the stock market. This influx of new retail traders led to increased chatter online about the stock market and a rise in social media stock market groups. One very influential group during this time was Reddit's WallStreetBets subreddit, which grew to over 1 million subscribers during the beginning of 2020. WallStreetBets became famous as a group for retail investors who were interested in risky, aggressive, and speculative trading activities to make quick money. All of these factors surrounding the pandemic economy combined to create a perfect storm that led to explosive, non-stop gains in the stock market for almost a whole year. And this was the environment that the GameStop short squeeze came from. People were chasing massive returns in the stock market and had progressively begun to take more speculative trades and higher risks. In fact, I would argue that the GameStop short squeeze began during the point of peak speculation in the pandemic stock market. People were more active in the stock market than ever and constantly looking for the next big trade. So when Ryan Cohen, the successful founder and former CEO of the massive online pet retailer Chewy, began to also buy GameStop like Michael Burry, people took notice. In August of 2020, Cohen disclosed that he had taken a 9% stake in GameStop. This was a big deal because Ryan Cohen is notable for being a famous activist investor. Activist investors are people that buy significant stakes in a company in order to gain influence so they can make changes to how the company is actually run. So when Ryan Cohen announced his 9% stake in GameStop, he began to put pressure on GameStop's board of directors and management to make serious changes to the company. When those private conversations with GameStop's management didn't work, he wrote an open letter to the board of directors sharing plans to transform the struggling video game retailer into an online shopping destination. This open letter and plan to transform GameStop's business helped to attract attention from investors who were intrigued by Cohen's track record of success with Chewy and e-commerce. After all, the short-selling thesis against GameStop that hedge funds like Melvin Capital promoted is that GameStop would eventually go bankrupt due to the rise of e-commerce and digital video games. As a primarily brick-and-mortar store that sold physical games, GameStop's business was being threatened by the increasing practice of purchasing games online, either through e-commerce retailers like Amazon or directly as downloads on game consoles. While GameStop did have a website where people could buy online, their e-commerce business had never gained much traction compared to larger competitors. Because of these business trends, the general consensus on Wall Street was that GameStop was going bankrupt, and it was just a question of when, not if. But Ryan Cohen investing in the company and proposing business changes began to change the narrative. Because the short-selling argument surrounding GameStop was primarily based around the company's failures in e-commerce, Ryan Cohen's involvement in GameStop and expertise in this area was seen as a potential catalyst for the company's turnaround. His ideas for transforming the company into an online shopping destination helped to spark even more interest in the stock among investors. This helped to fuel the speculative trading environment around GameStop and contributed to the eventual short squeeze. With the increased attention surrounding GameStop because of Michael Burry and Ryan Cohen, a small number of individual investors on the WallStreetBets subreddit began to look at the stock much more closely. One retail investor in particular, named Keith Gill, noticed the potential in GameStop stock and began to acquire a position in GameStop for roughly $53,000. Keith went by the moniker Roaring Kitty online and began to post about GameStop on YouTube and Reddit's WallStreetBets subreddit. Keith considered himself a value investor, and on his YouTube channel he would post videos explaining why he believed that GameStop stock was considerably undervalued and overshorted. He began to gain a following online for his bullish outlook on GameStop and for sharing frequent updates on Reddit on the current value of his GameStop trade. As GameStop's price began to gradually go up, Keith's update showed him making significant gains, which helped generate interest from other retail investors. Keith essentially became a bit of a face for retail investors who were interested in GameStop, and the publicity he brought to the stock helped generate excitement with other people. But what made people particularly interested in Keith's position was his theory that there could eventually be a massive short squeeze in the stock. Keith noted that GameStop was the most heavily shorted stock in the entire stock market. In fact, GameStop stock had over 100% of its available shares shorted at one point, as short sellers were borrowing the shares and selling them back into the market repeatedly to other buyers. When those new share owners lent those same shares out to other short sellers, shares in GameStop were being shorted multiple times, leading to over 140% of the shares being short at its peak. This was due to hedge funds like Melvin Capital, which were heavily shorting GameStop in large quantities. Having over 100% short interest was a big deal, because people on WallStreetBets and other social media platforms began to speculate about the potential for a massive short squeeze in GameStop. A short squeeze can occur when a heavily shorted stock experiences a sudden increase in demand, causing its stock price to rise rapidly. As the stock price suddenly rises, the traders who borrowed shares to short the stock begin to lose a lot of money, since they now need to buy the shares back at a higher price than what they originally sold them for. To limit their losses, short sellers will often buy shares of the stock back in order to cut their losses and return the borrowed shares to the lender. Since short sellers are also borrowing shares to sell for money up front, a broker can also force short sellers to close their short and return the shares to the lender in what's known as a margin call. Brokers do this to manage risk. If a stock begins to rapidly increase, there is a risk that short sellers might not have enough money to buy the shares back. So this is why brokers will sometimes margin call short sellers if a trade begins to move against them. So if there is a sudden spike in a heavily shorted stock's price, it can cause short sellers to scramble and be forced to cover their positions by buying shares. This can create a buying frenzy and feedback loop that further drives up the stock price, as short sellers are essentially forced to buy the stock at higher and higher prices due to margin calls. This phenomenon is known as a short squeeze, when short sellers are forced to buy shares at increasingly higher prices in order to cover their positions. Owning shares in a stock that short squeezes can be incredibly lucrative, but it is also very risky and unpredictable because the stock's price is rising due to shorts being forced to buy and not necessarily because of improvements in the actual company's business. But since GameStop had over 100% of its available shares shorted, people on WallStreetBets and other social media platforms began to theorize about the possibility of a massive short squeeze. For most of the start of 2020, GameStop stock had been hovering around $4 a share. But starting in August, things began to change. The growing optimism about the company due to figures like Michael Burry, Ryan Cohen, and Keith Gill began to create increased buying interest. The stock began to increase substantially, and by the end of the year it was over $17 a share, which was already over a 300% increase in the stock. This was already putting significant pressure on hedge funds who had not covered their short positions when GameStop was at $4 a share. But on Monday, January 11th, everything changed when GameStop appointed Ryan Cohen to its corporate board of directors. Investors were excited about the possibility of Ryan Cohen leading an e-commerce transformation for GameStop's business. With this news, the dam began to burst and the floodgates began to open up with another surge of buying. Over the course of just 4 trading days, the stock would double from around $19.40 a share to $39.92 a share. The last time GameStop had a share price this high was at the end of 2015, meaning that most short sellers who had jumped in after this point were now significantly underwater and had a substantial loss on their GameStop short position. The flurry of trading in GameStop and the cult following it was beginning to draw on social media from retail investors led to the term meme stocks being coined. The meme stock term was used to describe the phenomenon of social media and large groups of retail investors driving interest in particular stocks. The growing success of the GameStop short squeeze led to copycat short squeezes, with retail investors looking to cause squeezes on other heavily shorted stocks like AMC and Bed Bath & Beyond. By this point, the wheels were already in motion, and GameStop was on everyone's radar. Short sellers were completely trapped. With over 100% short interest, excitement grew among speculators about the potential of just how high GameStop's stock could go. This created a fear of missing out effect where everyone wanted to buy GameStop out of fear that they would miss the trade of a lifetime. The massive influx of buyers caused GameStop to rise to over $147 a share by January 26th, a massive increase of over 250% compared to the nearly $40 a share it was trading at just 1 week before. But even these eye-popping numbers weren't the end of the short squeeze. And then on Wednesday, January 27th, it finally happened. The GameStop short squeeze had already become a global news story that everyone was talking about. But just when you thought the short squeeze couldn't go any higher, Elon Musk tweeted out GameStonk and linked to the WallStreetBets subreddit. Elon Musk's influence at this time cannot be overstated. This was before his messy acquisition of Twitter had started to hurt his public reputation. Instead, Tesla stock had been an unstoppable force during the pandemic and had risen over 800% from March of 2020. So as founder and CEO of Tesla, Elon Musk was an extremely popular influence among investors at this time, particularly retail investors. His tweet after market close on January 26th, acknowledging the GameStop short squeeze and WallStreetBets, got even more eyeballs on the stock and created a lot of retail speculation about what his intent behind the tweet was. Some even theorized that Musk may have been sending a signal to the small investors on WallStreetBets to keep buying shares of GameStop. After Elon Musk's tweet, the stock began to go absolutely ballistic and made a massive move higher after hours, and the very next morning GameStop opened up at over $350 a share, compared to the nearly $148 closing price just the day before. The following day, the stock reached a high of $483 a share during the trading session. Needless to say, GameStop short sellers had been absolutely devastated at this point, as they were margin called and forced to buy shares at increasingly higher prices. Hedge funds lost billions and billions of dollars in the GameStop short squeeze. Gabe Plotkin had to get a $2 billion cash injection from his former employer, Ken Griffin, and his hedge fund juggernaut known as Citadel, in order to keep Melvin Capital from liquidating entirely. As word was spreading that many hedge funds like Melvin Capital were taking significant losses from the GameStop short squeeze, this also attracted many other people to buy GameStop because they wanted to stick it to hedge funds and Wall Street. The GameStop short squeeze started to morph from what initially started as a trade to make a quick buck into a sort of movement and rallying cry against Wall Street manipulation. You had new people who were flooding into WallStreetBets with this mindset of wanting to bankrupt a hedge fund, and the mantra became to hold GameStop shares at all costs. The idea was that the more retail buyers held their shares, the higher the share price would go and the more losses short sellers would have. Of course, this mindset from the new people joining WallStreetBets and looking to stick it to the hedge funds was just not how markets work though. For every single buyer in a stock, there always has to be a seller. And since traders in the stock market are looking to make money, a stock's price can't go up forever without people starting to sell and take profits. While retail investors were driving a lot of the excitement around the short squeeze surrounding GameStop, they weren't the only ones benefiting. It's believed that many hedge funds also bought GameStop during the short squeeze and made significant profits. Triggering a short squeeze was a win-win situation for them. They could make a lot of money by going long GameStop, and also bankrupt some of their hedge fund competition that was short on the other side of the trade. At least one hedge fund came out publicly saying that they made more than $700 million from a trade they placed on GameStop. So while the narrative was that institutional investors were short GameStop and all of the buying activity was coming from retail investors, the reality is that plenty of Wall Street firms were also involved with pushing GameStop higher. But underneath the surface, the GameStop mania from the short squeeze was putting significant financial stress on different financial institutions. Top US financial regulators were quick to call a meeting to discuss and monitor the situation for any possible systemic risks to the financial system. With market volatility increasing exponentially, individual organizations like the trading app Robinhood were running into liquidity issues and at risk of failing entirely. It's important to note that while stock market transactions look like they happen instantly, they actually take 2 days to settle. Stockbrokers like Robinhood work with a type of institution called a clearinghouse. It's the job of the clearinghouse to make sure that trades are settled, and that the stock is transferred to the buyer, and the funds are transferred to the seller. Since it takes time for these transactions to settle and for the stock and cash to trade hands, clearinghouses require brokers like Robinhood to deposit money as collateral with the clearinghouse to support the trades a broker's customers are making during the 2-day period between the transaction date and the settlement date. The amount of collateral the clearinghouse requires from the broker changes depending on different factors, like the broker's customers' stock holdings, how concentrated those customer holdings are in certain stocks, and the volatility of these stocks. So if the broker's customers are buying more volatile stocks, the clearinghouse will require the broker to deposit more collateral to fund their customers' trades, while they are in the 2-day process of settling the transaction. This collateral helps to minimize risk for the clearinghouse in case the broker's customers default during this period. With the extreme volatility taking place in GameStop and other meme stocks, clearinghouses raised the collateral requirements for brokers like Robinhood tenfold. So on the morning of January 28, 2021, Robinhood had approximately $696 million in collateral already in deposit with their clearinghouse. But it had a collateral deficit of approximately $3 billion, which it was required to post to satisfy the clearinghouse's fund requirements. Without posting that extra collateral, they were at risk of losing the ability to clear trades for their customers altogether, in which case all transactions on Robinhood would become impossible. Robinhood was completely unprepared for the sudden increase in collateral requirements and had to scramble to find a solution to their huge liquidity issue. Robinhood was able to get a temporary waiver from the clearinghouse for its collateral requirements, but they had to act fast. Since Robinhood already didn't have enough cash on hand to give to the clearinghouse as collateral to support their customer transactions in volatile stocks like GameStop, and they couldn't risk their collateral obligations increasing even more, they made the decision to temporarily disable buying for GameStop and some other meme stocks on January 28th. This meant that the only transactions that could be made for GameStop on Robinhood were sell orders. These sell transactions would have the effect of lowering Robinhood's collateral requirements owed to the clearinghouse, which would help them out of their liquidity crisis. In addition, Robinhood had to borrow billions of dollars in emergency funding from existing investors in order to address the liquidity crisis and have sufficient collateral to give to the clearinghouse. Robinhood was not alone in restricting GameStop trading, as buy orders were also disabled on Webull, and options trading was restricted on Charles Schwab and TD Ameritrade. Retail investors were rightly outraged by this turn of events. Disabling buying for GameStop and only allowing sell orders had the effect of stopping the momentum of the short squeeze entirely, and gave short sellers a reprieve where they were able to cover without risk of buying volume pushing prices up further. While Robinhood and other brokers enabled limited buying in GameStop the next day, the damage had already been done. While GameStop was able to stage an initial comeback, the stock quickly peaked and then began to decline as the momentum was now gone. Many retail investors that were late to the trade and bought GameStop near the top were stuck and left holding the bag, as the stock's price began to fall back down to around $40 a share from its highs of $483 a share. The aftermath of the GameStop short squeeze was full of investigations and finger-pointing. Some on Wall Street and in the media tried to blame retail investors on Reddit and social media platforms of colluding to trigger the short squeeze. Keith Gill even had a class action lawsuit filed against him, alleging that he engaged in market manipulation with his posts about GameStop on Reddit and YouTube. But this lawsuit was later dismissed. On the other side of the spectrum, retail investors were outraged with brokers like Robinhood and hedge funds, and alleged that market manipulation had occurred. There was a feeling among many retail investors that they had finally beat hedge funds at their own game. But when retail finally won, Wall Street changed the rules and restricted buying in GameStop. A particular theory began to emerge, with many people speculating that Ken Griffin's Citadel pressured Robinhood to restrict buying in GameStop after Citadel invested $2 billion in emergency funding into the hedge fund Melvin Capital, which was short GameStop. Ken Griffin's Citadel Securities is also a significant customer of Robinhood's order flow data. So many speculated that Ken Griffin could have easily leveraged this position over Robinhood to influence their decision to restrict buying in GameStop. But this theory had very little evidence to support it, and the lawsuit alleging that Citadel and Robinhood colluded to restrict buying in GameStop was dismissed due to there just being not enough evidence to support this theory. A class action lawsuit was also filed against Robinhood for their role in restricting buying GameStop shares. But a federal court ruled in January of 2022 that investors could not pursue negligence and breach of fiduciary duty claims against Robinhood, since Robinhood's customer agreement allowed for restrictions on trading. Congress held a hearing about the GameStop short squeeze with numerous witnesses like Keith Gill, Citadel CEO Ken Griffin, Reddit CEO Steve Huffman, Melvin Capital CEO Gabe Plotkin, and Robinhood CEO Vlad Tenev. Much of the scrutiny in the congressional hearing was directed at Robinhood's role in the events, in particular their decision to prevent buy transactions in GameStop. But despite the many opinions about who is to blame and the various investigations, no lawsuits against anyone have seemed to gain traction, and little regulatory changes have happened. A 140-page report published by Congress in June of 2022 called for the SEC to design new rules governing liquidity for clearinghouses, but nothing has happened to date. As for the hedge fund Melvin Capital, they were never able to recover from the massive losses from shorting GameStop, and news broke in May of 2022 that they were shutting down. Nowadays, GameStop stock is well below where it was during the short squeeze. The company has split its stock since the short squeeze, but compared to the $483 a share high point, the company stock is now trading at what would have been around $91 a share when adjusted for the split, which is a substantial loss for anyone that bought near the top of the short squeeze. The company has also struggled to gain momentum with its attempted e-commerce transformation, as the company's revenue has remained stagnant and below pre-pandemic levels. Despite this, a significant group of GameStop retail investors never left. They believe there will be another short squeeze that will launch GameStop to new highs. On social media and GameStop subreddits, the conversation often resembles cult doctrine more than stock analysis. They call themselves apes, and they believe that by banding together, they can trigger what they call the MOAS, or mother of all short squeezes. Many of them believe that hedge funds are still secretly over-leveraged in short positions on GameStop, and that one day soon, the squeeze will return, only bigger. Even though all public data shows that short interest is nowhere near what it was back in 2021, you can still find endless theory posts online filled with charts, SEC filings, theories about naked shorting, and synthetic shares. They believe that by continuing to buy, hold, and DRS, they will eventually trigger another short squeeze. DRS stands for Direct Registration System, a method to register shares in your name instead of holding them with a broker. It's seen as a way to lock GameStop shares out of public circulation and lending programs and help trigger the short squeeze. Any opinion or evidence contrary to the GameStop investment narrative is quickly labeled as FUD, fear, uncertainty, and doubt. Many of these GameStop believers who bought during the short squeeze have no intention of ever selling and believe that they will one day be vindicated. But the reality of the GameStop short squeeze is messier though. While there are many different opinions about what happened with GameStop, the truth is that the events surrounding the short squeeze are complicated and nuanced. While there was certainly a David versus Goliath element to the story, with many retail investors taking on hedge funds and winning, the lines were also not quite as clear-cut in reality. Many Wall Street hedge funds also made money by buying GameStop early and then shorting near the top. And not every retail investor came out ahead from the GameStop short squeeze, with many investors losing money by buying near the peak. The people who benefited the most from the GameStop short squeeze are the traders who saw and predicted the potential for a short squeeze early on and saw the favorable risk versus reward. But many of the people that got swept up in the mania and jumped in after the short squeeze when GameStop stock was trading well beyond its fundamental value ended up taking massive and serious losses because the risk versus reward was poor. In the same way, the hedge funds that were short GameStop for years, to the point where the stock was over 100% short, were also pursuing a trade that had terrible risk versus reward. One thing is for certain though, the GameStop short squeeze is one of the craziest events in stock market history, and proved that retail investors are a growing and significant force in the markets. And the fact that many retail investors were the first ones to spot the potential for the GameStop short squeeze shows that retail investors can be savvy traders too. But the cult GameStop following that developed after the short squeeze, they may never realize that they were too late to the trade and are waiting for a short squeeze that may never come. But be sure to let me know your thoughts on the GameStop short squeeze in the comments below. And make sure to subscribe to the channel for more finance and business content. Thanks.